say an employee is now given that car for $95,000.
Yeah.
Why don't we round it off? Let's call it $100,000.
Yeah, let's do that.
Right. Say Herlene now is an employee of her own company, or think of it like any other employee. Like she doesn't own the company, but she's an employee who's received a car costing $100,000.
Yeah.
What is she now including in her income as taxable benefit because company has now given her a car for personal use?
Yeah.
What's that look like? Let's work through two scenarios.
Sure.
Say the company purchased the car
Yeah.
and given it to her. She drives it home every single night.
Mm-hmm.
She comes to work with it, and that's her car for to her disposal.
Yeah. So it's her car. She gets to drive it. People don't realize that they may think, yeah, I'm getting this benefit. It must include something on my tax return, but they don't realize how expensive it can get.
I think people think that nothing happens
Yeah,
on
they
the
might
tax
even
return.
think there's nothing on their
It's
tax
written
return.
off.
Yeah, well, they might think, no, it's owned by the corporation.
Yeah.
I'm getting this car for free. Why would I include anything on my tax return? But the fact that you're driving it personally, you're incurring a benefit.
Yes.
Right? Even though they're not giving you cash as like a bonus or salary, they're giving you a car. Yeah. So there's a mechanism whereby you have to include 24% of the cost of the vehicle into your personal tax return, and you have to pay personal tax on that. And that's every single year.
Oh man. So it's so 20, the way I guess break it down. So it's on a monthly basis. I know the calculation works on a monthly basis. So it says 2% per month.
Yeah.
For the month you had the car.
Yeah.
I mean, let's say Herlene had the car for the whole time.
Yeah.
So she bought $100,000 car. The company did.
Yeah.
Gave it to her. $24,000 per year is this taxable benefit.
Yeah.
That she needs to be given T4 slip for as an employment income.
Yes.
Even though she hasn't received $1, and then whatever, then she'll pay tax on that $24,000. Cash tax has to be paid for a benefit that is non-cash.
Yeah, and this happens every single year.
And it's the original cost.
So you would think about the economics.
Doesn't that suck? Like
it does, because a car actually depreciates in value.
As soon as
you drive it off the lot.
It drops like 30% is what I hear.
Yeah. So, but unfortunately, the calculation, you have to calculate it on the original cost every single year.
Who wrote these rules, honestly? $100,000 car. Let's just say Herlene kept this car for like 4 years.
Yeah.
You're in year 5.
Yeah.
You're still calculating your benefit as if it's $100,000 cost, which is the value.
Imagine 8-10 years.
Yeah, still.
And you're at the highest tax rate. You might end up getting to a point where you've paid tax equal to the value
or more than that.
On that car.
Yeah. So I think after on $100,000 car, after 4 years, you're approximately the same. You'll be at like $96,000.
Yeah.
Of like income that you've taken into your personal tax return.
Yes.
On the 5th year onwards.
Yeah.
You're basically going to be paying taxes over and above, and you still don't own the car.
Yeah, you don't own the car. No, it's the corporate car, right? So corporation's car. But yeah, like people don't think about that, right?
And then the funny thing is, like, that's just a taxable benefit just on having the car made available to you.
Yeah.
There's a whole separate calculation for having the company now paying for the car use.
Yeah.
So like gas, repairs, insurance, all that good stuff.
Yeah,
so like
all the costs of the vehicle.
That's paid by. Can you explain that? What is it called?
It's called an operating benefit. So since the corporation is paying for all the expenses related to the car on a yearly basis, but you're driving it personally and you're incurring that benefit, they want to calculate how much the company's paying on your behalf in their simple way.
On a per kilometer basis.
So what they do is they take 34 cents per personal kilometer that you've driven, and you have to also include that onto your personal.
So if average family drives about, I think the statistics in Canada is about like 24,000 kilometers per year.
Yeah.
Assuming Herlene drove the whole time personally.
Yeah.
24,000 times 34 cents per kilometer. That's like a third of the cost. So like, what is it, 8,000?
Yeah. Yeah, around $8,000.
About $8,000 are added to the $24,000 for the car. That's been made available to you. So you take $24,000 plus $8,000, so $32,000 total.
Yeah.
and that's the cash equivalent of income that's added to your income for having that.
Yeah.
Okay. And then assuming that Herlene is,
and you have to do that every year, right? Yeah, we're talking about that's just
that's
1
an
year.
annual. That's an annual cost.
I want to reiterate that.
Yeah, it's an annual cost. So like $32,000 goes to your tax return, and let's assume Herlene is at top tax bracket, 54%.
Yeah.
So she's paying in around $16,000 to $17,000 of taxes in cash, while she has not been given cash. I think I totally understand like why that is set up this way.
Yeah.
All they're trying to do is like put you in the same position as if you did not get the car, you got cash instead, and you actually spent that money and you would have incurred that tax. I agree with the policy. It's the mechanism of how these things are calculated, especially if it's like tied to the original cost.
Yeah, I was going to say because it's tied to the original cost, because the value of that asset can't be equivalent to cash dollars after year 3 or 4, right? You prefer the cash at one point because the value of the asset has reduced.
I would say, I mean, I know for a fact that clients reaches out to us and they ask us these questions, and we have to educate them on some of these numbers and mechanisms and break the myth that you're not writing anything off per se.
Yeah.
But most people don't. I think most people just like, hey, got a job offer, and they're gonna give me base salary of this, bonus of that, and I'm getting a car for free or whatever to like as a perk.
Yeah.
And then they don't notice on the T4 slip that they've got this benefit added for which you just didn't pay any. You're paying taxes on it, but you don't receive any cash for it.
Yeah, exactly.
And the calculation is so skewed.
Yeah.
That it's calculated by year 4 on the same car. You're just basically on $100,000 example. You're like upside down almost.
Yeah.
Right. The cost of the vehicle is less than what you paid in taxes for.
Yeah, because it's being calculated on the value, but the asset doesn't reflect that value. Right. It's reduced.